Welcome to this fourth session of the Financial Expo session here in Manchester, which is the panel sessions. I'm delighted to welcome on stage 5 of the more distinguished luminaries of our profession who will give us the ability to ask. I'm going to ask them some questions, but also throw open to the floor to ask them some questions as well. And their names are up here, so I won't go through the whole process of naming and shaming them, but you can see up there who they are and where they come from. I'm going to start the questions with a fairly open one around, gentlemen, following the general election, what do you think is most likely to happen to the housing and mortgage markets in the UK? And we'll start the front with Adrian.
I think the good thing about the elections now, we've got some certainty for the next 5 years. Obviously, housing was very high on all of the parties' agenda. And with the Conservative government, we've obviously got the Help to Buy ISA and the new affordable housing coming in. I think the big challenge over the next 5 years, and I think housing will be good, will be around the European referendum, and if that brings any uncertainty.
Steve, anything to add to that?
Hopefully we'll start to see things move a bit more. I think it's been a relatively slow start to the year, a little bit of borrower apathy around waiting to see what's going to happen around the election. Now we've got a little bit more certainty around who's come in. I think people will be more confident to put properties on the market and start to and get things moving again. I think for me as well, the big challenge we've got is, as we know, and it's talked about an awful lot, is supply, and we want to see clearer policy from the government around how we're going to address the supply challenge. That's the big one for me.
And Rob, from the King of Mortgages of Essex, your view of where we are.
Well, a title, thank you very much. It's very kind of you. I'm amazed and appalled that housing wasn't a bigger battleground in this general election. But I've been saying that for the last 3 general elections. I think it's an absolute national disgrace that as a proud first world nation, we have such a lack of supply of new build properties coming into the UK. And let's not just blame the last coalition government or the previous one. Let's blame the previous one and the previous one and the previous one. This is a long-standing problem. So it's quite simple. I think that housing wasn't the battleground for this election because too much rubbish was talked about with UKIP and Europe. I think it's been avoided, and I'm not entirely convinced that over the next 5 years enough positive steps will be made to sort that problem out. But that to me is number one priority. There is no issue with demand. First-time buyers still want to buy houses. Landlords still want to rent houses. And the dynamics of our island nation is we continue to grow, family dynamics continue to change. We just don't have enough rooftops to stick our people in, simple as that.
And Martin, in terms of that, I mean, is the kind of strategy around brownfield site and wrapping more houses around the existing conurbations the answer here, or is there something more we could be doing?
I think there's lots more that we can do. I hope now that they're in government they forget that they mentioned bringing back right to buy, because I think that would be a total disaster. I don't think we've fully recovered from the one in the 80s. We don't have the skill set within the councils to actually sell them and then build some more, and we potentially don't have the land. I think wrapping around current brownfield, that's good, but I think there's also the regeneration of current areas where it's not just empty properties, it's dilapidated properties where there's no cohesion between a government, local councils and maybe investors, private equity, where you could actually build and regenerate something and then put it back into the market as a whole street, a whole development, whereas individual investors won't go into a street that's half empty and do it themselves. So I think that there needs to be a little bit more joined up thinking, which could be a challenge, but it could be achieved.
Alan?
I think the word strategy and housing market can't go in the same sentence. So if we look at what happens for the last 40 years, it's everything to do with the housing market is tactics. Tactics by politicians to win more votes, whether that be right to buy, whether that be help to buy schemes. So we've been building less houses pretty much year on year since 1969. So I say get it out of politics, give it to the Bank of England, Bank of England obviously are going to be around for a very long time. Most politicians have a 2 or 3 year tenure, so clearly they can't do anything that's going to affect the housing market in the long term.
Okay, moving on then. Just looking at where you might think gross and net lending volumes might go in 2015 and why, and is that going to get impacted at all with where base rate goes? You want to start that, Martin?
Gross lending, I still think will be about 210, as I said before. Net lending, I suppose, as a distributor, I don't worry too much about that. I'll leave that one for the lenders and their balance sheets. I think we still got a few challenges to get to 210. I think, as we heard earlier on today about whether lenders start coming early, late, or last minute on MCD could have a little impact on causing a little slowdown or confusion. But 210, I think, is quite solid.
Alan?
Yeah, pretty much the same. I don't think we're going to see anything spectacular occur this year. Pretty much the year's done, isn't it? We're sort of heading towards June now, so there's a 3 or 4 month pipeline for mortgages to actually get through the system. So from what I've seen, I think it's going to be pretty much the same as last year, with a little bit maybe of a kicker at the end.
And Rob, are you in the same space on this, or you think there's something more in the market?
I don't think the market has the ability to grow by more than that right now with the number of advisors out there. You know, you still get the horror stories of advisors that get clients after being waiting 4 or 5 weeks and more for branch base. So, you know, the market cannot grow with the number of advisors currently advising, in my opinion. I think in terms of base rate, which was the second part of your question, I think, wasn't it? I think there's a bit of a fly in the ointment here of having a majority Tory government, and it's this group of maligned individuals in Middle England that don't have debt but have savings that are pretty vociferous and the mainstream of the Conservative Party. And I think what you might find next year is there's no real reason to increase interest rates other than a bit of tokenism to get those group of people on board. And I sense, but again, you know, we've all been wrong more often than we've been right on this one, but I sense that will come about probably in Q1 of next year.
And Steve, from a lender perspective, looking at this as predominantly intermediated lender, you see this staying as a more strongly intermediated market, and what volumes we're seeing?
Sorry, say that again, Rob.
In terms of volumes for 2015, but also a more strongly intermediate market from a lender perspective.
Absolutely, yeah, no, absolutely, I do. I think we'll continue to see the broker and advice sector of the market playing out really strong. I think the high street lenders still have capacity challenges and still have challenges around the sort of cost of running a mortgage advice business. So I think it's still a period for brokers to make hay to an extent.
And Adrian?
Yeah, I'd probably agree with Steve. I think it was about 65% of business last year came through the intermediary channel. And I think if the market's up anyway on last year above the 207 billion, that's a positive. I'd probably agree with the panel on where they're going on that. I think you're seeing more lenders come into the intermediary market and look at intermediaries to distribute their products. And I think certainly over the course of this year, if the market's up, the percentage through intermediaries will be up as well.
Yeah.
Okay. And moving on then in terms of, we've touched on it briefly, interest rates. Do we think that any interest rates, when it comes, will be passed on, or is the price war we're currently seeing going to keep rates very much suppressed? Rob?
I think you've got to look at as being a consumer and looking at the current interest rates and just saying how could they get any lower than they are. And 1.99 5-year fixed rate, I think a couple of lenders offer that, and there's some great ones. I just don't understand the economics well enough to understand how they could get any lower and still be competitive, unless lenders are encouraged to lend at a loss, which I can't imagine the regulator and the PRA would allow them to do so. I think there isn't going to be so much an issue with price war. I think the interesting battleground might be around this old bedfellow of technology. How can we as a community make it easier to transact with our ultimate consumers by taking away a lot of the waffle and rubbish that comes into a mortgage application. So, a call to arms for the mainstream community. Stop mucking about with rates, you're not going to get them any lower, and let's make the process easier for brokers to deal with and get mortgages completed quicker, because we should be able to. Alan and his team back in 2007 in his previous capacity, that battle hasn't moved on, has it? In 7-8 years, we are no further forward in technology issues in the mortgage industry than we were back in 2007. And I think the next 12 months, that will be a major change, shift in focus. And I think a lot of resources are going to go in to make the capacity issue taken away by speeding the process up. And that's got to be a win double for intermediaries, in my opinion.
Alan, you want to add anything on that?
Lenders don't price their mortgages off bank base rate. They price their mortgages off the cost of funds. They're two different things. Clearly, if bank base rate goes up, that will push swap rates up and LIBOR rates up. So I think you will see some move. I agree with Rob. Rates are pretty tight to the cost of funds at the moment, certainly in mainstream. So I think if we get a base rate rise move, it will probably have a knock-on impact, and you'll see that come out in rates. It will come out immediately in fixed rates, because swaps basically are a prediction of where the cost of funds is going to be at any point in time. So I think you'll see that pretty quick. But the rates are good now. The market's very competitive. I think it will still be competitive even when rates go up. I think what we will see, however, is a change in demand. So once customers figure out that mortgage rates can go up as well as stay the same forever, remember, a lot of customers have never experienced a rate rise. I think you'll see people start to look at their finances, start to speak to brokers to see what the options are to keep their cost of borrowing as low as possible. So I think a rate rise will actually just be good for the broker market.
Adrian, anything you want to add to that?
No, other than, I changed to a 5-year fix 12 months ago when I didn't think they could get any lower, and of course that would be 20 basis points cheaper this time round if I took it out now. I think, sort of adding on from what Rob said there about technology, I think once a lot of lenders land the regulatory piece around the Mortgage Credit Directive and the IT hours that they're putting on from that, I do think you'll see lenders look to kick on and advance in terms of technology.
Okay. Martin, where do you think the market's going to go on procuration fees in the next 12 months?
Upwards is the simple answer.
Does it matter? Does it matter?
Well, it matters if you're an advisor and you're making a living, and there's the extra cost of regulation and the FCA fee increases, etc., that are going on. Obviously, it won't impact on the advice given by the advisor, but I think there is a lot more work that is now carried out to make sure that an advisor is qualifying for the loan of that lender. And a few lenders did pull back their prop fees in the downturn, so I think it's only fair that those fees should start moving back towards what we would expect.
And Adrian, your view on this? Pick on you, because you're the only big lender.
I think ultimately the market will drive where prop fees go. I think when Martin mentioned there, some lenders pulled back, and you've seen some lenders move their prop fees this year a couple ahead of the rest, but more often than not, you've seen those lenders move back into the pack where most of the lenders play. At Nationwide and TMW, we regularly sort of review where our prop fees sit to make sure they're competitive. And of course, as I said, really it's where the market drives them. I don't see it being driven down, that's one thing.
No. And Steve, from an Aldermore perspective?
I agree with what Adrian's saying there. I mean, that's an easy answer. But the one thing I think that is happening, and we certainly see on a regular basis, is that brokers are reviewing their models and looking to charge fees where they feel it's appropriate, where they feel that they're giving the requisite advice and recommendation, and it fits for their business model. So we see more and more of that.
The last thing I want to touch on before I go out to the audience, if there's any questions, is what impact, Alan, you think the LTI cap's having, and is it biting in the right places or in the wrong places?
It's definitely having an impact, because I can tell you each lender will have calculated how many customers will have been taken out as a result of that cap, and it will be you've seen some lenders actually withdraw quite rapidly back to 4.5. So it does have an impact. The issue I always have with that kind of market intervention is that the problem isn't LTI, the problem is simply lack of housing, which drives up the cost. So what they're trying to do is artificially keep the cost of housing under wraps, and they're using that particular method to actually do it. I always liken it to a Virgin train going at 125 miles an hour. You're trying to stop it with a pair of bicycle brakes. So it will have some impact, but it's not the right thing to do. I think there's other ways that you can actually control the market. But definitely for the unfortunate individuals that get taken out, that are on the edge of this, it's bad news for them. But impact, I think we'll see more of it. I think we're going to see the FPC intervene in other areas such as buy-to-let. So I don't think we've seen the last of it.
And Rob, from a broker perspective on this, do you see this as necessary or overcooking and stopping some people who should be able to borrow from borrowing?
Well, I'm not sure there was that much evidence to say that the market was overheating, and I know London is always being used as the overheating market, which always baffled me a little bit, because, you know, how could the average person overheat a market that they can't be part of? What was overheating the London market, frankly, was a supply of overseas investors buying, you know, vacant properties. So I think Alan's spot on. I think housing is being, people are being prevented from owning. I think there is a deep-rooted government policy, irrespective of political class, where home ownership is not seen as something that is overly important anymore. And I think that does kind of mask those poor souls that have to go into the private rented sector, whose rents are at record highs, that are going up astronomically, got few rights, and there's issues there. So, yeah, it's, yeah, the market seems to be regulating itself quite nicely. Thank you.
Okay. Right, I'll open up questions to the floor if anybody wants to ask this esteemed panel anything. Is there anybody who would like to ask them a question? Save it from being just me. No? Okay. If there isn't, I'll carry on. If you do reach the point where you want to just raise your hand, and I'll let you intervene. A year into MMR, are we in the right place now with the kind of data requests and the way that lenders are dealing with affordability and transitionals, Martin?
No.
You want to expand a bit on that?
I don't think some of it, if we're being honest, is just down to the lenders. I think it's an interesting argument, especially with affordability, and Alan mentioned that might be a call to action at some point. I think a lot of those customers who get that call to action won't be able to get a mortgage, or won't be able to remortgage anyway, due to the affordability calculations. I think they're set at the wrong level. I think maybe the interpretation either of the FCA of where they thought that level would be and where lenders have actually put that level, that there is a dislocation that I think needs to be addressed. I'm not sure whether that will be addressed until maybe all the lenders have had their first sort of reviews with the PRA, FCA, etc. But I think, to me, that's the one bit that hasn't really worked yet. I just think we're taking out more people out of the market than everybody expects. We just haven't felt it yet. Adrian, you?
So I guess looking at where we are and the documentation bit, Robert, that you said there, sort of 12 months into MMR, we've reviewed our decisions constantly, and what you've seen in terms of the documents we've asked for, we've actually reduced them, particularly in terms of income verification and income referencing. Very early on into the process, we reviewed our affordability model, partly as feedback from brokers, and we changed that more favourably. And on Nationwide, actually, for the vast majority of people, we improved affordability on our own brand, and I can only speak for that. In terms of self-employed, went from 4 times to 4.75 times. I think in terms of looking at the transitional rules and people coming over to us, we've always assessed on remortgages, and I don't see at the moment that we change that.
So you don't feel that those affordability rules are beneficial then in terms of being able to avoid them for remortgage?
Sorry, no. Well, I mean, I think it's an interesting one for us. Coming in, we've always assessed the affordability of an applicant from a remortgage purpose, and that's a risk thing, which protects the society. I think it's an interesting one from our point of view for existing customers, that if you come to the end of a deal and you want a preferential or a loyalty rate there, you can have that without having having your income assessed, so you don't get trapped on a variable rate. So that's an opportunity for them.
Okay. Steve, anything you want to add to this?
I guess the only thing I would add is that from a documentation perspective, what we often see is that some distributors may be asking for more documentation than the lenders actually want. And it gives us a challenge as a lender, because often we'll end up with more documentation than we need. But you present an underwriter with more documentation, and then they'll often they'll use that documentation and interpret it as they see fit. So I still think there's some joined up sort of conversations that need to be had, lenders and distributors, just to make sure that everybody understands what everybody needs, and not to overload where necessary.
And so just moving this on a little bit, Al, I mean, do you think that lenders have properly understood these affordability rules on product transfers and their transitional arrangements? And why is it that more lenders are not using these to avoid full affordability checks? Is it a PRA requirement rather than a conduct requirement that's causing some of this?
Look, I think MMR was a force for good. You can't argue with the rationale that people need to be able to afford their mortgage and pay it back. So I think that's fine, got no issues with it. Obviously, there are impacts of it, so why are rental yields increasing? So that's a direct result of people being unable to get mortgages. So I don't have an issue with it. Each lender's going to have their different views as to how they calculate affordability. There is no edict from the FCA as to how you do that. You make your own, you take your own views, and it will be largely around commercial views. Why are lenders not perhaps using the transitional rules? Well, of course, they don't need to. Most lenders are doing pretty well at the moment, so why go out and do something difficult when you can do something easy? It's just human nature, isn't it? So I don't think lenders, the current volumes are filling the lenders' appetite, so perhaps they haven't been quite as aggressive as they could be on transitionals.
Martin,
do you think potentially, though, that was an opportunity for lenders with margin? Because, as we said earlier, one of the earlier questions, they're fighting on margin at the moment, mainly because they can't fight on anything else criteria, whereas if some went into the transitional arena, there could be still good deals for the customer, but they could take more margin, so it could help profitability. Yeah,
but there's other ways you can get margin. There's lots of options. I agree with your point totally, but there's lots of options. You've seen a lot of lenders just go towards buy-to-let. There's some margin opportunities in that type of lending. And ultimately, it goes back to transitionals, a bit like the retention issue that we had sort of 2004, 2007. Lenders were very motivated about retaining their customers. Of course, that issue's gone away. Customers can't move in a lot of cases. So the average life of a mortgage, when we were back modelling it in 2004, was about 2.5 years. You're looking at 5 to 6 today. So the retention issue isn't quite the same. So I'm not suggesting that any lender necessarily looks at it like this, but why would you need to stimulate your back book moving artificially? Maybe you just leave it alone.
Okay, moving this on to something else now. I'll start down the phone with Adrian on this. With FSE requirements to know your broker continuing to escalate in all possibility as we go into the senior persons regime, what further steps are lenders likely to make to know brokers, or do you think lenders are now in a place where they've done enough due diligence?
Yeah, I mean, we obviously with the networks and the corporates, we have a close relationship with them and their members. We're quite fortunate, I guess, at Nationwide, and if you combine the brands, we've got 50-odd BDMs out there. So basically, we can offer face-to-face support or see any brokers that come on there. We do have a process where if you're a new broker into the industry or registering with us, or you haven't transacted with us for 12 months, we'll put a sort of mandatory visit for the BDM to go out and meet that person and assess them and fact find them. So I think we're in a good place, just given the size of the sales force we've got out there, Robert.
And Steve, from your perspective, are we in the right place on this?
Absolutely. I think what we're seeing is a real change in the role of the BDM. I think the BDM plays a much more important role now in understanding the broker's business, the aspirations for the growth of the broker's business, and how, as a lender, we can provide a solution. So I think we're seeing a real shift in the way that BDMs and BDM sales forces are operating to truly understand and truly know the broker.
And Martin, from that kind of intermediary perspective, how are you viewing this?
I think lenders have got a lot better off. I think where they fundamentally, or a lot of fundamentally got to look at, is they've got to accept that the directly authorised market is not going away. It's not shrinking, it's not growing, but it's not going away. And I think there is very much a bias and probably an ease with regards to know your broker to talk to the head of compliance at a network to understand what's happening underneath it. And there is the concern of how do I look after the one-man band in Cornwall or the north of Scotland, but they're not going away. So I think lenders need to work out how they are going to deal with the directly authorised market and treat them as equals with the appointed reps, which is not happening in every case.
And Rob, from your perspective then, as sitting there having responsibility for a firm and what goes on in there, do you feel that sits with you, or do you think the lenders should have a right to come and exercise due diligence on you?
Yeah, 100%. If you've got nothing to hide, why hide it? But it's very plausible, and it's it's difficult to think what more lenders could do. However, here's the dilemma. Why do we see so many brokers that get booted out of networks for dodgy business reappearing in other networks doing the same business? I don't get that. So I hear what you guys are saying, but there are still some real bad rogues out there. And two words, okay, it's perhaps a pipe dream, individual registration. What a massive lost opportunity that would have been. But this is the bit I don't get. We've never been more diligent to know our brokers. So how can these rogues still operate actively in the marketplace from one network to the next? I don't understand it.
And Alan, anything to add to that? I don't think you're going to see a change in behaviour. If lenders haven't got this right already, then they're probably in a bad place. So I think it's just going to be the same as it's been over the last few years.
Now, I'll start with you, Alan, on this next question. With the changes that are coming to buy-to-let, so the mix of consumer buy-to-let, the commercial buy-to-let, effectively within the residential proposition, and the CML voluntary code, wouldn't it mean simpler just to regulate the whole buy-to-let market?
I think you've asked me that question before.
Perhaps.
But look, I've been saying since M-Day back in, when was it, 2004, that the buy-to-let market should be regulated. And what we've ended up with is the worst situation that you could probably think of. You've got non-regulated buy-to-let, you've got consumer buy-to-let regulated by the FCA, we've got the CML code, and then of course you've got the lender's own regulation on top of it. So it looks a little bit difficult to figure it out. So to cut the answer short, lenders are just regulating it. That's what we're doing. We've been doing it for years. We just treat it exactly the same as we do a regulated mortgage contract because the process is too difficult to do anything else. So I think we've ended up with, by accident, a regulated buy-to-let market anyway.
But as a lender like Precise, will you play across all parts of that landscape?
Yeah. We're going to do it all. I think we may have just underestimated how big this consumer buy-to-let market is. So I've heard 5%, 10% bandied about. I can tell you we did a survey in 2012. It was relatively small, a couple of thousand people, and that returned a much bigger number. And we weren't asking the question for that purpose, it just happened to be one of the questions that we asked. And it was nearer 40% of customers were in that I inherited a property, or I'm divorced, I got married to another divorcee, and we've ended up with 2 houses and rented one out. So I think most lenders will actually think that market's a bit bigger and therefore won't walk away from it.
John, Sam's got a question, so.
Hi. I was just wondering if, with the consumer buy-to-let issue, you've ended up with a flat and you've decided not to sell it for whatever reason, then you're still making a conscious decision for it to be a business transaction because you're choosing not to sell it. And isn't there a clause where you can just sign a piece of paper anyway to say that it's a business agreement? So surely that's going to negate the problem of things falling into consumer buy-to-let. I just think it seems like all this regulation has been put in place, but then you can sign a form to say that it's a business proposition, then you're out of that loop. Is that right?
Yeah, I'll answer that. That won't be allowable. So part of the rules on consumer buy-to-let is that the lender has to be happy that the property is a consumer buy-to-let property or not. So just signing a bit of paper, the underwriter will be sitting there going, how did you come by this property? And what are your future plans? And if they don't agree that it is purely a business transaction, the lender won't do it. So I don't think that will occur. It's a bit like the situation you've got today. We've heard of gaming, people saying they're doing a buy-to-let when in fact it's resi. Clearly lenders look out for that and they make their own judgment. So I think it will be pretty clear-cut whether it's consumer or not.
The wrinkle, I think, Sam, is that if they've already got or had a buy-to-let property, they can sign that bit of paper. Yeah. So it's that bridge, but it's those people coming to this for the first time. It's their first buy-to-let transaction that comes out of that let to buy or inherited property transaction that drops it into that consumer category.
And let's remember, this whole it doesn't make sense, does it? Because why wouldn't you just regulate the whole thing and just cut out the process that says you've got to check some stuff? It doesn't make any difference. It's been driven by Brussels. This is not a British piece of regulation, so it's just a byproduct that we have to comply with. But the easiest way, like I've said before, is lenders are just going to treat everything as regulated and just have one process for everything.
Because ultimately the lender is going to want to make sure it's affordable, which is the large bulk of what sits in there.
Yeah, what we're focused on is that deal affordable? Can the customer pay it back? Whether it's consumer buy-to-let or a business buy-to-let, sort of immaterial.
And the advisor is still going to be on some form of net for suitability because they've still got a duty of care, even if it's unregulated. They still have a contractual duty of care, if not a regulated duty. And that's the gap that sits in here that makes it's more about government saying they're not tying things up in bureaucracy than it is about common sense. So that's strangely where we've ended up. Any more questions from the floor?
Afternoon, gentlemen. Moving away from buy-to-let, lending into retirement, is the industry doing enough at the moment to tackle this? And if not, what should the industry be doing?
Is there a volunteer to take that question, or I'm going to have to force you into it?
I'll start.
Yeah.
You
want to
speak
speak just a bit more to the microphone?
It can be no's and yeses.
Martin.
The answer is no. I don't think we are yet. I think there's a lot of confusion and a lot of talk about which way it's going and how it should be dealt with, whether it's hybrid products that you're seeing sort of some of the equity release providers providing that where you can pay part interest and then roll it up at some point. But I think there's a wider bit in that when are you retiring? Depends on whether you're born. I think I'm at 68 at the moment. I'm sure that I'll probably move again before I actually get there. Thank you, Rob.
You don't look 68.
No, yeah. Thank you. But yeah, so I think that will move. So again, I don't think lenders' criteria and risks appetites are moving with that. It seems to be it's a flat 65 or it's a flat 70. Well, actually, and I think we're in quite a moving dynamic that we're not keeping up with, definitely.
I would like to add as well, I think intermediaries are still really nervous about this issue of lending to retirement. Got to remember, it wasn't that long ago where if a client went a month over 65, it was a breach, it was a compliance suspension, there was a complaint, and you possibly couldn't work. So I think the dynamics of the socio-economic dynamics of people working older, pension age changing, needs to almost settle in a bit, because I think there's that inbuilt concern that are we being responsible by lending to clients over 65? And the answer in most cases is yes, we are, absolutely.
I think it's also, you've got pension freedoms coming in now, so actually lenders are taking into account pension income to look at affordability, etc. It might not be there by the time they retire anyway, or not all of it that was in the original underwriting because of how they now have access to it. So again, I think there's a lot of things happening around the edges that somebody needs to actually work with, and again, I think that's maybe a Amy Imler CML conversation at some point.
I think it'll be a conversation in a room in about 2 weeks' time with FSE and the Ombudsman, so it'll be quite interesting. John?
Can I make an observation?
No, you don't.
I'll make an observation. Earlier this morning, when Robert was doing one of his presentations, he was slightly surprised about the lack of remortgage business and why we're not doing remortgage business. If you go back and look at the ages of man when they were taking out mortgages, etc., and their ages were moving between the 40s into the 50s, isn't this part of the issue that we've now got with the lenders? There will be a lot less remortgaging until you resolve this problem, because when someone gets to, say, 51, 52, 53, and they would normally be thinking about taking a 20-year mortgage or whatever the case may be, if they've got to do it capital and interest, they can't afford it. So basically, it's all very well saying we need to resolve this, but this has got to be resolved by the lenders and by the regulator. It's as simple as that. The intermediary can't resolve it, but until you resolve that, a large slice of your remortgage market will not take place. It's as simple as that.
That wasn't a question, was it, John?
Yes.
Respond if they like, the lenders, but that's, that quite simply, I think, is where we're at.
So big plans from the challenger banks to move more into this market, Alan, or not?
Yeah, I'd like to. I think lenders have overreacted to the regulation. I turned 46 last month, and I'm now in that age bracket where you've got to tick 46 to 65 bracket. And what dawns upon you is that if I went to go and get a 20-year mortgage right now, I may well struggle myself. And looking around the audience, quite a few of you might be in that situation as well. So the point I make there is that the industry is going to have to deal with this issue because we're all getting older. There's a lot of grey people around, and the big lenders are going to run out of 60% LTV prime business to go at some point. So we're all going to have to wake up to this issue. That being said, I know the CML is focusing on it right now. So I think that the industry is starting to actually grapple this thorny issue. And it is a little bit thorny because with affordability being so important, it's quite difficult to figure out what somebody's affordability is going to be in 10, 15, 20 years' time. So let's not underestimate it is actually quite a difficult issue. But my prediction is we will solve this problem, because if we don't, none of us will be able to buy any houses and all the mortgage lenders are going to go bust.
It's an interesting one. I take your point out when you say we can't, but we actually do that now.
Find a microphone to speak down. Great, thank you.
We obviously do that now to a certain extent because we assume that somebody's going to be in the same job for the 25 years of the mortgage that they've got at the moment, don't we? Yeah. We make it harder for the income that they might not need at the end for the pension. So I don't know the answer, but it's all making assumptions at some point that a lender has to make that assumption and stick to it and take that as that's how we're going to work it.
But that's why I think it will be solved. I think you can do it, and lenders will get round to it because it just makes sense commercially to go there. And certainly we look at that market as if the mainstream lenders don't do it, maybe it becomes a specialist market for specialist lenders. But my prediction is it won't be too long before we actually start seeing some relaxation of policy around lending into retirement.
And it's much more involved in specialist distribution, Rob. I mean, there are other lenders out there away from the mainstream who will do this type of business.
Yeah.
Price.
Yeah, no, absolutely. There has been, particularly a lot of the smaller building societies have done. So there is opportunities out there, frankly, but sadly, those smaller lenders aren't going to take up the volume necessary. That will only happen by the top six coming in and doing it, frankly.
Okay. I mean, I'll just add my comment to this, which is it's not all about conduct and affordability. Part of it is the affordability assessment, and with a simple tweaking of words, the regulator could get this to a better place. The other part sits on the balance sheet side with the PRA and the kind of risk-weighted asset that attracts to longer-term lending, particularly if the lender's not been in that space before, it becomes higher risk from that perspective when you get into all the more complicated stuff in there. So it does cause problems for the techie guys who sit on the finance side of the businesses. Any other questions from the floor?
Just off the back of the FCA's presentation on the Mortgage Credit Directive raised lots of questions, some concerns from brokers. I just wanted to ask the panel what's the biggest disruption the market faces from MCD in their opinion?
Do you want to go first time? We'll go down the line. Straight down the line on this.
So I'm a director of IMLA. We have been looking at this and obviously talking to Robert over at Amy. So the biggest issue here is going to be the bits of paper that we produce. So MCD effectively is two things. It's, do you produce an ESIS or a KFI Plus, and the cooling off the reflection period. Both of those are relatively easy things to do. The issue comes about in that you don't have to do an ESIS till 2019. So we did a survey to see how lenders were going to go, and guess what? Split down the middle. About half are going to go KFI Plus, half are going to go ESIS. So the issue is going to be, I think, for intermediaries. It will be, some lenders are doing on first charges will be doing KFI Plus. On buy-to-let, they might be doing a simple, straightforward KFI. On second charges, you have to do an ESIS. So it's just, I think it's that little bit of confusion that will be the disruption. But ultimately, we're going to get through it because the lenders are going to produce the bit of paper and the intermediary is going to issue it to the customer. But I'm sure for a few months, there'll be a little bit of teething problems around sourcing systems and just really what bit of paper is being produced by which particular lender and sourcing system.
Martin.
Yeah, I think that will be the disruption. I think how big a disruption it will be is how open the lenders are with the intermediary market and how much notice we get of what changes they're doing and when they're doing them. I think MMR, we got about halfway. I think there was a lot more openness than normal, although it still felt that a few lenders held bits back because they felt there was a competitive advantage or probably disadvantage by telling us. I think we've got to be a little bit more grown up and say that this is a change we all need to be able to handle properly. If we get told late, then we're going to have to pedal very hard, and I think as intermediaries we just get on with it and we deal with it. But ideally, it'd be good if we knew in advance so that we can all plan properly for it.
Rob?
Well, I'm not a lender, so really the issue with the paperwork is of little relevance to me, but I take Alan's point. I think an issue that we need to think about is that for the first time, all intermediaries that want to remain as independent mortgage advisors, and the FSA were very clear on this, will have to consider second charges in their decision-making matrix. And the concern I have is the natural size of the market, if they do that, so big that actually the existing second charge providers are actually big enough and got enough resources to better cope with what I think will be a groundswell of additional business. So I think there's an issue there, and I know that some lenders, Precise here, will upscale and will be able to deal with an increase in amount, but I'm not sure if all lenders will be quite the same. And then is there an issue there where there's a real big demand for these products, but actually there's not enough supply, so then rates start to go up and then the competitiveness then goes out. So that's a concern, I think.
And Steve, in your terms, MCD?
I haven't really got anything else to add. Robert, the guys covered it.
No, pretty much the same. I think the guys have covered that off there.
Okay, and from my perspective, just to answer, I think the biggest problem is actually going to be around tangible disclosure for people who are used to doing things over the phone. Because I think the need to give tangible disclosure before you carry on a conversation. If it's face-to-face, it's easy. You hand a bit of paper over and it's tangible. If you're trying to do anything by telephone, you're going to have to get that emailed out and see it's been opened. So get a read receipt, an opened receipt, before you can carry on the conversation, or something like that, or send some form of text that gives that initial tangible disclosure. If you're going to do it not face-to-face. And that's going to be a difficult part of the process for intermediaries. And that tangible disclosure is going to be a bigger document than it is today, because we pared that all back to verbal disclosure under MMR, and we're going to bring some of it back in. So from a broker perspective, there's more work to do than perhaps even some of the lenders have got to do, and that's part of the challenge that sits there.
One more thing I'd just like to add to that, picking up, I think on Rob's point, second charges I think is going to go down. Because I see lenders today that are doing 10, 11 times income on second charges. You all probably know which ones I'm talking about. Clearly, once MCD comes in, you can't do that because you'll have a 4.5 times, 15% of your business can't be more than 4.5 times, and we'll all be operating to a 5 or 6 times lending income. So all of that business is gone as soon as MCD comes in. So I think you'll actually see a softening in the size of that market initially until we have a bank base rate rise and the market gets stimulated again.
I'm going to ask one last question of the panel, and we'll start at the other end. What do you think a broker has to do to be successful for the rest of this year, to still be sitting here in 2016, having felt they've done better than they've done before? Adrian?
More of the same, really. I think the intermediaries out there that we've got, the 10,000 or so of them now, pretty much do a good job at the moment, Robert. And I think the market is favouring you guys, but keep on doing what you're doing.
Steve?
Yeah, agree with Adrian, and work closely with lenders. Keep close. There's a lot going on. The regulation landscape is changing, as we've been speaking about, and I think lenders can play a big part to help brokers understand from the lender's perspective what's coming down the line. So I think it's a case of stick close to lenders.
And Rob?
I don't want to sound patronising or condescending, but I suppose I'm just about to. Just make sure you're not busy fools. You're all really busy, and good luck to you all, and make this time last. But by being busy, make sure you give yourself enough time to look at innovation in the market, because it is out there every day. There's new products, new lenders, new schemes and opportunity. And if you don't, you will end up losing those really valuable customers that you've worked so hard over a really crappy 8 years to keep and to do really well. So that's, I'm not wishing to be offensive, but just don't be busy fools. It's easier said than done, but make yourself time to research the market and keep an eye on what's going on, because there's a lot going on right now. It's easy to do.
I think it's echoing a lot of what Rob said. It's planning. It's great at the moment. The pendulum is swinging our way with regards to the split of business between intermediary and retail. If we think the top 6 banks are going to be happy for that to carry on for the next 4 or 5 years, they're not. They're going to be working on things to make sure that they have capacity to take some of that percentage back. So we're not going to have customers queuing at the door. We've got to make sure that we are still dealing with them and they become clients, not customers, so that they always want to come back to you and deal with you. So it's not just about purchase, it is that remortgage you're moving on. It's just making sure that we don't think that we've won, because the pendulum doesn't stop still.
And Alan, finish.
I wanted to say what Martin just said. You stole it. Make hay while the sun shines. Clearly, the pendulum is in the favour of the intermediary today. It won't be like that forever. The big 6 will be working on technology solutions to their current situation, and it will swing back the other way at some point in the future.
Okay. Thank you for attending this session, ladies and gentlemen. Could I ask you to say thank you to the panel for their contributions today?